Hi, Danielle.
Hello, how are you?
Can you hear me? Oh, I'm
Can
fine.
you hear me?
I can. It's great to meet you. Thank you so much for granting this interview. I've been a fan of yours for a while, and
Happy to
your
be here.
reputation, your reputation precedes you coming in here. I just want to show your website. So let me just make myself the presenter. And you know, if I read all of your credits, Danielle, it would take up the whole interview. So my question to you, I'm showing your website, Money Strong, right now. My question to you is this. You know, I'm very interested in the beginnings and, you know, what was the catalyst that shaped somebody to take a path that they did. Now, were you thinking at your Sweet 16 or at prom and telling people, I'm going to work at the Fed one day? Are you with me?
I would say think the opposite. I'm with you. Can you hear me?
Yeah.
Hello?
I'm here. Can you hear me?
Yeah, no, if you can hear me, I can
Yes,
hear you great.
I hear you.
Great.
I can hear you. So I'm wondering if, you know, what was your age when you had an idea that you were going to be headed in this direction to have the type of career you have now?
Well, I was a typical teenager who was rebelling against their parents. My father taught economics, so I said, that's the last thing I'm going to do. I'll drop dead before I do that. So it was, it would have been after Wall Street, after I had retired off of Wall Street, and when Richard Fisher called me on the phone, and it was pure ego because he had such a big ego. You know what? This guy's inviting me for lunch. I'll go. And that was the beginning of the end of me becoming a bureaucrat.
Interesting. Okay, so you probably had other dreams, and it turned out this way. I want to ask you about your book because what a great title, Fed Up. It almost reminds me of that movie, I believe Peter Finch was the actor, where he got everyone in New York to stick their head out the window and said, I'm so damn mad, I'm not going to take it anymore. Do you remember that movie?
Oh, I do. And there was a point that I became fed up, and it wasn't until kind of after the worst of the financial crisis, after the worst of the heat had dissipated, and those inside the Fed realized, you know what? Hey, we're using the wrong inflation measure, or we might have seen freight train headed for us. So there was a recognition that they were using measure, or they would have seen inflation in asset prices, which they didn't. And after they determined that they were wrong, they decided to do nothing about it. And that was what planted the seeds of me getting really fed up.
Okay, so there were a lot of people fed up. Number one, savers, financial repression. How about pension funds? And I see you've written about it, that, you know, people had to find other ways with zero interest rates and be pushed out on the risk curve to have a return that they needed for pension funds to become viable, and savers that never wanted to be in the stock market really got killed because they weren't receiving anything for being a saver, only a spender.
Yeah, I called it the send grandma to bed policy within the Fed, which really made me popular. Yeah, it was make sure grandma's deeply invested in junk bonds policy.
Okay. All right. So now we have a new Fed chair, Danielle, and I've done some reading. And do you believe that this will be a different Fed, and that Powell will be more tolerant of the air coming out of asset bubbles than people still relying on the Fed put like they had with Yellen and Bernanke?
Oh, I think he's already exemplified that he's got a lot more tolerance. I take my hat off to him. I think, given the volatility and how many times, you know, long-only investors have been frightened, that any of his predecessors would have blinked by now. So I think Powell having really just said, you know what, I've got experience in the markets, and this is how markets are meant to operate, and he hasn't said a word, I think it's a very good sign.
Okay, so then when doves come out like Bullard last week saying maybe the Fed doesn't have to raise rates anymore, the doves are now going to become the minority voice on the Federal Reserve Board?
Well, it's interesting you asked that question because Richard Clarida, who is up to take a position on the board, said just recently that he would like to see the entire balance sheet exit out of securities. So I said, check that box, because we don't need the Fed does not need to be in the business of credit allocation. Here's another practical person who would be a voter if confirmed by the Senate. Bring it on, because he would add to the voices that are rational, such as Randy Quarles and, as we've seen, Powell. I'm saying the more the merrier here. Let's bring in more pragmatists who understand what boneheaded policy is and the fact that that's a very technical term.
Do you believe there'll be a regression to the mean in asset prices like equities? We're already seeing it to a degree in treasuries with what's happened. LIBOR rates have doubled. Do you think that getting back to practicality and instead of just theory that we were on the hopium too long is going to cause some financial damage to asset prices, real estate, equities, you name it, that have been bloated and blown back up because of easy money?
Regression to when I was a rookie on Wall Street over 20 years ago, we were told that until price to earnings ratios hit the single digits, you couldn't declare the all clear. Well, we never even got there in 2009, Dale. So a regression to the mean is a regression to the mean. We got close to the 10 line, but we never got there. So what you described for today's investors,
it'd be a nightmare.
David Rosenberg, my friend. Well, David Rosenberg, my friend, once recently commented that 13 million workers have entered financial services since 2007. That's more people than what are in the industry. That means you've got an entire generation that doesn't even know what regression to the mean really means.
All right, so then we're in for some. Definitely, the times are changing.
We might be. The times are changing, but we don't know if we're really going to get back there. We don't know if it's a matter of there not being a Powell at all, or if the strike price is just a lot more flexible, let's say, than it was with Yellen or Bernanke or Greenspan. I think that any central banker would allow an economy following major disruption in financial markets. It's their job to make sure that the real economy is not damaged. So it's not their job to babysit the stock market, but it is their duty to look after the economy to the best of their ability. And if that means that the financial markets bleed into a serious recession, then it will be duty to act.
Well, don't you think the whole part of the motivation for raising rates, besides the normalization and liquidating the balance sheet, quantitative tightening that's going on, was basically to give the Fed some type of insurance in case a recession happened in the next 100 years, that they would have some ammunition to take rates back down, because it wasn't really inflationary pressures that were taking rates up?
Oh, absolutely. I think Powell would be so delighted if he could be dealing with Fed funds rate, but we're still not even there. And any threat to increase the rapidity of rate hikes, if the market even gets a hint that it be only 4 rate hikes in 2018, and now would say, Danielle, you put that only in quotes because they're hoping for 3 rate hikes total, not 4, even though the market has already begun in a 40 probability that we'll get there. Again, monetary policy for grown-ups is about. Monetary policy for grown-ups would allow Jay Powell to increase interest rates if the inflation data bore it out at every one of the 8 FOMC meetings. It was Ben Bernanke that hamstrung the process by after 4 meetings a year only, which effectively rendered the other 4 meetings lame duck meetings. That's why the market freaked out, because there was a little bit tougher inflation language in the May FOMC statement. They said that's against the rules. Well, guess what? Monetary policy for grown-ups, it's not against the rules. Every meeting should be live.
Interesting. And I'd like to get your thoughts on, Danielle, from the last crisis, our national debt has doubled. So LIBOR has doubled. And aren't higher rates going to make it even more difficult for the United States to fund and service debt?
Oh, absolutely. Just, I mean, in the month of February alone, we had interest expense for the country rise 10% over last year. And we know that we're just at the cusp of the deficit growing. We know that this is just the beginning. So absolutely, look, this is what happens when monetary policy backs the government into a really tight corner. Where even a flirtation with normalization of interest rates means that you can take Uncle Sam out in a dark alley because they can afford to pay interest expenses if interest rates rise much more, because we've taken on so much debt. We're at 21+ trillion and counting. Take on $250,000 of debt single minute of every single day, 724, and debt's projected to hit $25 trillion by next year.
How do we get out? How do we get out of this catch-22? By inflating, debasing the currency, or just defaulting? And can't rates go up without inflation? Right. So can't rates go up without inflationary pressure, because people have there's a confidence crisis in the currency, and they have to get paid more to hold our paper? So a strong dollar.
Well, a lot of people on yeah.
Go ahead.
Look, a lot of people on my Twitter feed have that as a worst case scenario. Until the Chinese, okay, maybe their second aircraft carrier is not made out of Legos, so it might hold water. But until we lose reserve currency status, that Armageddon moment where we lose reserve currency status is just not here yet.
Okay. Hopefully it never comes. So do you think that part of
a destination?
What about the destination? All right, so I'm losing you a little bit here.
An alternative. I mean, you look at the circus in Europe. I just came back from delivering a speech to some members of the European Parliament. You look at what's going on in Japan. In Japan, there are alternatives to the dollar, because countries have a bridge even further with their quantitative easing, and China can't get its act together because it wants to have, the world's super dominant economy, but have a communist hold on its population, and it's finding out that those two things happen to not be consistent with one another. Again, it's all good and well. My children take Mandarin, last resort scenario, but until we truly have an alternative to the risk-free asset, you won't see the dollar become abandoned. Doesn't mean, and there's major disruption in the markets, gold won't be the only place to hide.
The dollar will be too. Yeah, the dollar will be too. Can't both the dollar and the gold be a haven at the same time? I mean, everyone likes gold.
Treasuries and gold, yes.
Okay, so I'm just
saying treasuries, and even treasuries could get hit harder than treasuries could get hit, and gold could be the beneficiary. And I'm no gold bug. I'm just talking purely about historic correlations.
Okay, So tell us a little bit about this article you wrote, Brussels Bound. You were just touching upon that by way of Tokyo. Are the cliff notes of this article that the disinflation, no recovery, multi-decade Japanese economy is being transported to Europe? That's where it's going to hit next, and negative interest rates are not going to be a solution.
Well, negative interest rates have not been a solution, and I was actually in a debate after I gave my keynote with somebody who was very pro-ECB policy, and he said that the onus should have fiscal authorities to implement reforms that thereby allowed the QE's, the ECB's QE policies to be more effective. And I asked him a simple question. I said, how on earth are you supposed to expect for politicians, for governments to impose fiscal reform when you've got the borrowing costs of these countries at zero? I said, that just does not work. Politicians are effectively the kid in the candy store because their borrowing costs are nothing. And you know what? He had no answer. So the ECB is going to be exiting its tapering process, the expansion of its balance sheet September. It's looking a lot more like December. Most analysts don't the first rate hike, which would bring their equivalent funds rate from negative 0.4 to negative 0.2% until December 2019. So the basic premise of the newsletter that I just published is it possible for the world's gigantic European economy to go into recession with negative interest rates? You'd have to have a book burning party to get rid of the textbooks, because that hasn't happened. But that is what happened, and the pace of normalization is as glacially slow as it's been with Mario Draghi, who you have to say is boo, and he says more QE.
Yeah, it's interesting. The new kid on the block is the PBOC, right, Danielle? And you know, the Fed's been around for over 100 years. And the Fed has made several mistakes on staying too tight, too long, too easy, too long. Don't you think that the PBOC, having less experience than a Fed that has made many mistakes, is apt to make one?
Well, I mean, you know, they're, as you said, they're rookies, but they're playing with a huge printing press of their own. It is, as we know, where the bulk of the buildup on bank balance sheets inside debt markets has occurred, you know, since the great financial crisis hit. And there is indeed the potential for there to be a hiccup. But I would just put a huge however out there, because last I checked, we are borrowing our prosperity, and they're sitting on $3.1 trillion in reserves.
There are
bankers. They certainly have a lot. Yes, but they've got a lot more wiggle room in the event of some kind of a calamity in their markets, because they've got dry powder.
Okay, so they're our creditor. They're in a stronger position. Any view on them attempting the de-dollarization by being able to trade crude oil, settle it in yuan or gold? This is just another veiled attempt to be the new king on the block.
They desperately want for the yuan to be an accepted medium of exchange on the world stage. But again, it might work on a unilateral basis with the Saudis, maybe with the Iranians. But the fact is, if you look at where that particular oil benchmark, that baby benchmark, is being traded, it is smack dab in the middle of Brent and West Texas. In other words, traders don't know what to do with it. So
yeah,
I certainly think that the Chinese are going to continue having seminars and conferences, and you know, let's have a whole think tank. Let's try and figure out a way to force the yuan onto the world stage. Again, until investors don't think that there's a possibility that their investment's going to be, confiscated or nationalized, because again, it's a communist republic, and they've just had somebody declare themselves dictator for life. So they're going in the wrong direction to really build trust on the global financial stage.
Well, we have someone here in this country that likes that idea.
as
Don't we?
in
Someone who our president thought it was a great idea. I'd like to get to the fact that, you know, you and I have been in these markets for a while. Have the bond vigilantes reemerged and are powerful enough for us to, do you have any view on where the 10-year could end up? Or could this be a buying opportunity if normalization takes the stock market down for a correction? I haven't noticed on big down days in equities any flight to quality in the bond market.
Yeah, you know, we're not there yet, but I will say that it is somewhat encouraging that it looks like we have picked ourselves up off the ground in terms of the first indicator that there could be disruption in the making in the bond market. And you know, people ask me all the time, aren't you worried about the VIX? And I said, you know, you're following the wrong volatility metric. You need to be following the MOVE index, which is the volatility equivalent on the treasuries. That's
okay.
What
that's a pearl.
Keep your eye on. And this last week, as we've seen the 10-year rise above 3%, we have finally seen the MOVE begin to move.
Okay, that's a pearl. So I know a lot of people, 90% or better, are all paying attention to the VIX, but the volatility is more in the treasury market than it is in equities, especially at this time. So let me bring you to some type of conclusion here. I have no idea, you know, what you may think. I can't wrap my head around it. Any view on the cryptomania, Danielle?
You know, I'm probably the wrong person to ask because, you know, I'm still traumatized from being inside of a central bank. So I look at it as a reformed central banker would look at it. And I see cryptocurrency, and especially because Venezuela and Russia, and what do those countries have in common? But I see cryptocurrency as drive that central then use to learn from the mistake coin world, such that they are much their own sovereign cryptocurrencies.
Okay, so do you think the U.S. will adopt one? That way, their war on cash, you know, you go to the bank and you take out $5,000, they ask you what you need it for. So do you think eventually even though most of our dollars are digital anyway, that perhaps governments are letting this experiment go on so people get accustomed to it, and that would be the way for them to have a complete credit debit economy and know everything we're doing?
Well, luckily, that situation cannot play itself out.
It is lucky.
And Rand Quarles are running the Fed. They have both been very, very public in saying that rather than have some kind of a communist regime type of full monitoring of our purchases, that if Fed coin is to come to be, and I think they're certainly working on it, they have to. It's a matter of national security if our quote-unquote allies that really are not our allies are already deploying their own. They have both, Quarles and Powell, have publicly been adamant about the fact that any Fed coin transaction would have to be equally anonymous to that, as if you and me were to exchange a $100 bill for something. Equal anonymity.
Interesting.
And I hope that for our liberty's sake, that we continue to fill the Federal Reserve Board full of like minds.
You know what? What a great mission you're on, making this clear to people, because a lot of people think that, you know, that the Fed, you know, should be abolished, you know, Ron Paulish type things. And you believe we need a central bank. We just need people that are more in touch with the people than economic theory. Is that the gist of Fed Up?
Absolutely. You got it.
Well, Danielle, it was a pleasure.
Look, again, I don't mean to. Just one last note.
Go ahead.
Stop and think. and this is just food for thought as we part ways. Stop and think of what an opportunity China it was if all of a sudden we did not have an entity shepherding our financial system. Stop and think about that.
I'd be all for it. It'd be chaotic.
Well, so would the Chinese.
So what you're saying is it would be chaotic without a Federal Reserve.
I'm saying it would be vulnerable to attack.
Okay, so it's our economic army.
If we were the largest economy in the world, with no central.
All right. Well, you know, that's a great
if it's apolitical and if the way it's supposed to be.
All right. Well, thank you so much, Danielle.
It needs to undergo tremendous change.
Okay.
Thank you. I appreciate your time.
Okay. Thank you, Danielle. Good hunting, and thanks so much for coming to talk to us today. All right. Everyone, that's Danielle.
Thank you. Appreciate it.
DiMartino. Get her book, Fed Up. And you could follow her on Twitter at DiMartinoBooth, and her website is DiMartinoBooth.com to keep in touch with someone who is speaking for the liberties with a Fed, not just liberty without a Fed. And that's a wrap for the week, everybody. Enjoy your weekend, do your work, get ready, have your strategy ready, and most of all, don't just count your pips, count your blessings. Thank you for your attention today and all week, and see everyone Monday. Adios. Thank you, Danielle.